Nitin Jain, Principal Investment Manager at Kotak, joins in. Is at Kotak Mah UK. Joins us on the phone line from Singapore. Nitin, good morning and thank you very much for joining us. First, just give us an idea of this global equity sell-off that we saw. Is this just fund managers taking profit for the year in and, come January this will pass or even earlier? Or is this a larger growth scare?
I think clearly it's a mix of both. The first point that you're talking about, the year-end phenomena, is a smaller one. The bigger issue is obviously concerns on the global front on oil and its impact on major economies, and it has serious implications for a large part of the world. And there are now many reports which have come in of damage to industries because of capex related to oil. Even in U.S., job creation because of in shale gas states and non-shale gas states is very, very different. So I think people are taking this into consideration. It is, and the way it is falling off. Initially it was looked as a healthy thing for the consuming countries. Now it is a little bit of a mix there. So I think the assessment of that is going on at this point of time. And again, let's not forget this has been a good year. So there has to be some bit of profit taking which has to happen.
Nitin, hi, morning. So what is the assessment as far as India is concerned? Because net a fall in crude is a positive for India. So would India benefit, while the entire global markets are slowing down?
Morning, Sonia. Just to quote Mr. Jaitley, he said a couple of days back that the fall in oil price is a gift to India. So I think we need to capitalize on that gift at this point of time. At our end, in our portfolios, we are reassessing our positions in companies which have commodity prices as input costs. And we are taking incremental positions there. So we see that as a big positive, both from a macro perspective and from a micro perspective. Yes, on an overall basis, earnings will not see a positive uptick because of foreign commodity prices, because there are large commodity earners in the index. But I think on a macro basis, there is a 2.5% disinflation of the economy, if one were to look at from that perspective. And then commodity prices input in many companies is a significant number. So I'm looking at that as very positive for India, but we need to do many other things along with it. I think there is a lot of concern on other things which are not happening. We should not focus too much on oil only, but there are other things that we should look forward to, that we have been looking forward to in the last 6 months.
Actually, yeah, that was what I was coming to. How are you estimating the growth picture? The data is so mixed. We got this 21-month high PMI number. We got auto sales turning somewhat in November. And yet we just had Arundhati Bhattacharya telling us that she's deeply concerned about mining, where absolutely nothing seems to be moving across, whichever mining category you want to look at. How would you look at GDP or corporate earnings turning? When? I mean, how would you therefore rate the chances of an Indian outperformance in the next 6 months?
I think, next 6 months to 1 year to 2 years is the period that one is looking forward to. From a policy perspective, things have to move forward. On mining, I don't know. She knows better because they have a better perspective. I'm just looking at a simple metric at this point of time on mining, whether the coal auction will go through by March. And if that process is smooth, we would see some pickup there. Of course, on commodity metal-related mining issues, there are specific issues in certain geographies, but we heard over the weekend that one of the high courts has given permission to start mining operations. So there is some movement there also. But I'm looking at, from a mining perspective, I'm looking at just the coal auction to go through. And there are serious implications, positive side and negative side, if it doesn't go through on power sector, which is a very large sector. So we are looking forward to that on a medium-term basis, that how will that pan out. On a data perspective, we have stopped looking at monthly data a long time back on PMI and IIP. The relevant data, which is very consistent at this point of time, is the data which comes on inflation, where there is a lot of sanity in monthly data also. But in IIP and PMI data, things are fluctuating on a monthly basis. It's not worth looking at the monthly data, but look at quarterly data. So I think, clearly at this point of time, we have also missed in some ways that there were many holidays in this year as compared to last year. So, but if that gets adjusted in the next month, it could be a reversal of some numbers. So I think better to focus more on quarterly numbers than a monthly basis. But clearly, I'm looking at a much more policy-driven action in the next 3 months to drive earnings and GDP growth in the next 18 months and 24 months.
So you did say a while back that you're looking to increase allocation in companies that are exposed to crude in a positive way. Which ones would these be?
Very obvious ones are, at this point of time, are paint industry is a very, very obvious one. I'm not looking at only crude-related things, but I'm also looking at metal-related items. Cap good is one. So I'm just looking at cap good across the value chain. Consumer durables could be benefiting. And, some of these things can be short-term pain. Because clearly, like I said, in paints industry, there could be destocking by the trade, and there could be inventory hit on the existing inventory. So there is possibly a short-term pain which can happen. But clearly, on a medium-term to long-term perspective, these are important parameters which will play up. I'm looking at an indirect beneficiary of that. All the consumer companies, paint companies, all will have a gross margin expansion. Will they put more money in advertising? Can that be a positive thing to play up? So there are many plays which can happen from a crude perspective. Of course, the last leg of that is banking. If interest rate were to come off, they're already showing that interest rate is 7.8% on 10-year G-Sec. So we're clearly seeing an uptick in banking segment also. So it's across this spectrum at this point of time.
Okay, Nitin, quick answers since we're running out of time. Is this still a buy on dips market for you? And what kind of gains do you see in the Sensex or the Nifty next year? Can it do much better? Can it do as well as this 30% that we are sitting on for this year?
We can do better than that if we have very strong policy action in the next 3 months. Because then the visibility of the GDP growth of 7% plus starts showing up. At this point of time, there is uncertainty surrounding that. But I would take my base case to be around 15 to 20%, which is the earnings growth that we're looking at. Let's not forget that this year 30% had an element of re-rating on the back of the new regime. So now we're looking at the possibility of surpassing that can only happen if we see very strong policy action being taken in the next 3 months. Otherwise, from a base case perspective, we are looking at more from an earning growth perspective. And earnings growth for the next 24 months is looking to be upper teens, and which is where our base case, market performance is. Clearly, this is a market buy on dips. After the recent fall in the market, we are back below 16 PE multiple. Yes, there have been some cases of profit warning in recent days, but I don't think that we should extrapolate them to a broad basis. But clearly the market has dipped below 16 PE multiple 1 year forward. It's a market on buy on dips if the earning growth visibility is in the upper teens.
All right, that bullish note actually corroborates the kind of move we have seen in the market today. Nitin, thank you very much for joining us with your thoughts this morning.